Shane, you can begin.
Good evening and welcome to Axis Mutual Fund's series of webinars on the equity market outlook. Markets of late have been very, very volatile. The last 6 months or so have been characterized by persistent FPI selling, a lot of headwinds on economic factors, and to top it all off, you've seen commodities go through the roof on account of various macro and geopolitical factors. In, in view of all of this, the markets have been very, very unfavorable for long-term market participants. And this is what we categorize as a bear market cycle. Today with us, we've got Mr. Jinesh Gopani, who's the head of equities at Axis Mutual Fund. He's a veteran with about 25 years worth of experience in markets. So, Jinesh, that must be maybe four or five market cycles now. So we've got a wealth of experience with you to take our viewers through what you think about the markets and where should investors put their money from a long-term perspective. Over to you, Jinesh.
So thanks Shane, and very good evening to everyone who has logged on. Thank you for giving us this opportunity. While we start the presentation, before that I will just give my experience in terms of how markets have behaved over last 2-year period and how markets over a period of time climbs all wall of worries, and the investor ends up making good returns, steady returns over a longer periods of time. So clearly, friends, you have seen markets have been on a tear after COVID. During COVID, we saw markets going down by 35% in just 30 trading sessions. And from there, markets has almost more than double or gone up much more than that in terms of giving you that momentum and the returns, which was in a way a bit surprise to everyone. But nevertheless, the flow of capital, the flow of money, both domestic and foreign, led to this super momentum in this market. As economy opened up after COVID, clearly you saw the businesses coming back to momentum, and most of the businesses where we are invested at least have come back to pre-COVID levels. Various sectors have participated in this rally in last 2.5 years, and clearly you can see in the presentation, if you really see what has happened in the market and clearly how markets and then have behaved over last 6-month period, it's sort of a U-turn or a reverse U-turn kind of a situation. Some of the worries which are emerging as of now is oil, inflation and currency moves, which is more important and pertinent for India. Clearly, oil, as you would really see, is a very important metric for us to decide how the fiscal deficits and all those things will move. And hence, you have seen markets correcting from its highs. And in a way, I would say it's a good sign that there is a consolidation in the market. And now market will find equilibrium. There will be consolidation time, and then you will have a good move once things settle down in the global world. If you really see this chart, clearly India has been less painful as compared to other emerging markets or other markets, other developed markets. So clearly you can see the resilience of India, and that is purely because of our domestic consumption story, where India's GDP growth can be seen at 6.5% for next decade, and nominal growth including inflation can be around 11-12%, and which bodes well for many of the earnings company in India which are listed, which can grow at a handsome pace of 1x, 2x and 3x of GDP. Also, the resilience in the economy is no doubt because of the government effort. You have seen so many reforms coming over last 3-4 years period, and these are some of the reforms which you can see. The most latest one being production linked incentive scheme. So clearly land, labor, infrastructure, capex, production linked incentive is what government is targeting from a longer term point of view, rather than giving out dole outs in form of subsidies. And this bodes well from a structural story of India to create jobs and also create infrastructure, which would be in a way needed over next 10, 20, 30 year period, as your population grows, as the per capita income improves, and also as the urbanization of smaller town takes place. Next. Again, I was just referring to oil. Now we come to inflation. Inflation at 7% is not a worry, but again, it is really pinching hard on at the consumer, at the citizen level. So clearly, the focus has shifted of the Reserve Bank from growth to inflation at this juncture, because we all know once inflation goes out of control, it becomes very difficult to bring back into control, and which can lead to other repercussions, which might be more damaging for the economy. So clearly, inflation at 7% is an issue, but I don't think it is becoming a bigger issue. Also, the good sign or the good part is last 1.5 months you have seen significant correction in the commodity prices, be it soft commodity or hard commodities, and that should bode well for us. Also, good monsoons should further help reduce some of the inflation in the rural areas, which will again bring back growth. So I think inflation, again, it's a worry, but not a big worry at this juncture. If you really see why there has been sell-off over last 6 month period, is nothing to do with India. If you see this chart clearly, you will see there has been relentless sell-off by FIIs across emerging markets, and we are also facing that music. Last 12 months, India has seen 30 to 35 billion dollars of outflow, and which is in a way very I would say damaging thing at this juncture. But clearly, the domestic flows, and thanks to investors like you, clearly has been able to negate that negativity or the damage, and you have seen markets where they are. But clearly, the outflows are not related to only India concern. I think it is more to do with what's happening in the global world, be it Ukraine Russia issue, be it oil issue, be it China issue, be it US issue, and these are all keeping investors, global investors, on the edge, and hence there has been a relentless outflow from the emerging market. Having seen these outflows over now last 12-month period, I think we are just seeing first sign of abating of these outflows, given oil where it is at $100, and also the currency depreciation which has happened in the emerging market. I think we are seeing the abating of these outflows, and hopefully, if things go well over next three-month period, you can see again the FIS flows coming back, which should bode well for the market, because whether we like it or no, we are dependent on foreign capital for managing our fiscal deficit and current account deficit. Next. So clearly, as you see, and I'm sure you would be aware, our style is on quality and growth. And clearly, even when FIIs want to participate into India, they would look for quality and growth, and that is what they have done over last 30-40 year period. And clearly, India is a destination for growth. People see India from a growth perspective because you have 1+ billion population, you have per capita income which are 1/3 or 1/4 the size of China. There is propensity to consume, there is desire to consume, there is huge employment opportunity which can come back, and also the average age of Indian citizen is much younger. I would say 60% of the population is less than 35 years of age. So clearly there is lot of positivities and opportunities for many companies to set up their shop in India, and you have seen the Amazons of the world or Apples of the world really targeting Indian markets in terms of future growth. So clearly from that perspective, even FIIs would want to participate for 11-12% nominal GDP growth story, which is what India is offering. I think no big country in the world is offering now this type of growth, and clearly as FII flows return, you will see the quality stocks and the growth stocks bouncing back, which I would say have not done well over last 1 year period, and that is more to do with how the commodities have behaved in the market and how the momentum stocks, the high beta stocks have participated in the market. Next. Also, the good sign is from the froth of valuation, I think we are now coming to more reasonable levels of valuation. So across the board, you have seen good corrections happening, be it auto sector, be it financial sector, be it IT sector, or be it even commodity sector for now. So clearly there has been a good correction from the top, and which bodes well that the valuations are now coming to the range where people will start looking into India story in a more serious manner. And if momentum continues on the GDP side, you will see good quarterly numbers coming by. Maybe 1 or 2 quarters down the line, you will see a significant resurgence in earnings growth. And if that happens, and assuming the oil, inflation, and currency are stable, I think you should see good earnings momentum coming back, which should again bode well for the markets. Clearly, if you see, for us, long term is pretty long term. I would say at least 5 to 10 year kind of a view one needs to take when an investor really wants to make a good compounding returns for his or her needs. So clearly, my humble advice would be, don't look at 1 year return or even 2 year return. Maybe it might be good or bad. I'm not here to compare that, but I would say if you really stretch that string for a longer period of time, the consistency which the equity market offers is significant. And all good funds, if you really do the analysis, they would have outbeaten the benchmarks from a longer period of time and generated more than FD plus kind of return for a longer period of time. Also, the importance of compounding comes into play. So the compounding, which many people don't understand, I think the power of compounding you will really know when you invest 100 rupees now, and after 10 years you will have 10x of that earning, tax-free earnings, and the compounding returns what you make. Next. So clearly, as I said, what we feel an ideal philosophy for wealth creation is to participate in great growth stories of India, great businesses of which are flourishing in India, and be with them for a longer period of time. And over many cycles, even in Axis, we have been around now for 12 and a half years. We have seen over a longer period of time the quality and the growth basket has really outperformed the basic indices from a longer periods of time. Why I say is that normally quality and growth comes with few key parameters which I would like to allude. First is the governance angle. Clearly, corporate governance play a significant portion for anyone to have a stock in the portfolio or a company in the portfolio, and and there is a significant premium attached to that. And we have seen many companies destroying investors' wealth only because of this reason. So corporate governance is a very important aspect of this philosophy, and that is where the qualitative angle comes into play. And this leads to premiumization of the valuation also for that stock. Second is clearly the growth as a business model. We really feel that at 11-12% nominal GDP growth, there are businesses which can grow at 2x, 3x of this nominal GDP and clearly make money for the investors. Third is clearly avoid mistakes by not buying into stories which are again not good in governance, not good in business model. And we have seen that the more filter you take for the universe, for constructing the universe of the stocks, clearly you have seen avoiding those companies which have really made up well by having investment into some of the concentrated stories which have created a lot of wealth for the investors. Finally, good ROE and cash flow is the bedrock of any qualitative investment. So ultimately, quality should have some financial metrics, and that is where we feel that ROE, return on equity, is a very important aspect, because that takes care of your inflation or the cost of equity, anyways we may say. So good ROE, which is industry led higher industry led benchmark ROEs and cash flow denomination. I think these two are very very critical metric to decide the health of the company, and that is where we feel that quality and growth offers both good ROEs and cash flows. Keeping risk management in place, you construct the portfolio, and we are bottom up house. We have coverage of around 300 stocks. We have a ESG score, we have financial models, we have fair value of these target, we have corporate governance research, and basis on this you create a portfolio, construct the portfolio with a longer term view, and ensure that you have a high conviction portfolio with longer term view, and identifying businesses which are here to stay for longer periods of time. So I would say we play for businesses and not for prices. I think price is for people who are looking at markets on a day-to-day basis. But for us, investing is more about understanding the businesses from a longer-term point of view, and especially in understanding how the business will make return on investments, and also how businesses will throw cash flows over a longer period of time, because ultimately cash is the reality. If a company is able to generate a lot of cash with limited resources, limited capital, I think that is where we will put our money, and that is where the valuations are also rewarding. So clearly, if you see, some of our funds would have done well in different cycles, but clearly we have seen 9 out of 12 years we would have outperformed the market. Obviously, we don't do well when there is a high beta trade, when there is a euphoric trade, where normally quality and growth tends to be sideways or consolidate, and then again when earnings come by, we start doing well. So ultimately, I would say our portfolios are slaves to market dynamics changing towards quality and growth, and also markets are slaves to earnings growth, and earnings growth comes into companies which are here to stay for a longer period of time and who have a very good business model. So just coming to the portfolio strategy, clearly volatility is your friend. Volatility will be our friend. There is lots happening on a day-to-day basis. However, we are not looking at markets on a day-to-day basis, but clearly there are news flows which are keeping markets alive, volatile, I would say. Starting from US, how the US Fed rates will behave, how much they can go up, or how much the US economy will go into recession, to Ukraine-Russia issue, whether that leads to higher oil prices or oil prices will stabilize at these levels or may further go down, to China, whether China and the supply chain where China has a strong hold, whether China really comes out of this COVID, and there is a stability in the supply chain management. So clearly there is a lot of volatility in the market. It is going to be year of consolidation is what we feel. However, if for India, again, as I said, oil, inflation and currency are very, very critical. And if oil is around $100, if inflation is below 7%, and currency is also stable, I think we are in a good wicket, and second half can be much better than the first half. Yeah. So last point on the portfolio positioning, as I said, that we will look for quality and growth. That is our long overarching philosophy. However, as I said, we are bottom-up stock pickers, so we are looking into stocks across sectors, and wherever we feel that companies are able to grow, able to throw good cash flows, able to generate good ROEs, I think that is where the conviction of the portfolios will happen. We would have done some changes during the ongoing COVID crisis and thereafter, and we would keep on playing as an active fund management team, and ensure that the ideas what we are bringing into the portfolio, we have a significant headroom in terms of understanding of those business models.
Sure.
Yep.
Thanks, Jinesh. I think that was very brief and very well articulated. To the audience, we will be taking questions with Jinesh in approximately a minute or so. So on the right hand side, you would see a box where you can type in your questions for Jinesh. While that queues up, Jinesh, let me throw the first question out to you. The markets have moved very erratically over the last 3 months, and for Axis as a fund house, we, we, we've uh, we've seen a significant underperformance over the last 6 months, and even to the last 1 year. How do you want to talk to investors today vis-a-vis say 12 months ago on how to position portfolios and how to position in amidst these ongoing volatility markets?
Sure. Thanks, Shane, for this question. And I think it is important to address this at first go. So clearly, friends, as we have shown you one of the slides that 9 out of 12 years we have outperformed the market. So clearly, there are cycles where different styles work. Sometimes the value style does well, where let's say more of a commodity type companies continue to do well because of the overseas global factors, and there are styles where quality and growth comes back as and when things stabilizes. So clearly, Shane, if I have to answer in one line, is clearly the style really matters, I would say, from a longer point of time, but from a near point, you cannot take that call and shift the entire portfolio from value to growth or growth to value, because that will be damaging for the portfolio. Because I think the communication from our side to the investor has been always on quality and growth, and we feel that India is a real growth destination, and as and when things stabilize, earnings come by, I think we should be in a strong wicket. And already we are witnessing that. If you see the some of the companies which have come out with numbers where we are large shareholders, I think clearly that gives us very positive feedback and confidence that companies are here to stay, companies are growing above industry averages, and they will report higher ROEs and cash flows. Also, I'm sure you will have one more questions around valuation. So as we have already articulated that valuations have also corrected for even quality and growth companies. So I think now you are in a situation where you can relate valuation to the high growth ROEs and cash flows. And I think as things settle down in the global world, you will see the growth companies getting fair share of their flows again.
Sure. So you spoke a lot about quality and growth, Jinesh, in an environment where the rest of the world is tottering, where global growth is the IMF has pegged global growth at about 2.5% or so. What differentiates our understanding of growth? So let's look at it maybe 3 or 5 years ago. Growth was very different from what it is today. So how have you changed your thought process on growth and quality, or has that changed at all?
No, I think nothing has changed as such. So we are pretty simple players, I would say, in the market. We look for India as a engine of growth. We have nothing to do with the global world in that sense. So if you are, so you see, frankly speaking, India is a domestic growth-driven industry. A large part of your GDP is domestic-driven. Only 15% comes out of exports. So clearly, if India has to do well, the domestic consumption story, domestic manufacturing story has to do well. And that is where we have a lot of hope. If you really go back to, let's say, 20 years back where US was, or maybe 20 years back where China was, I would relate more to US versus China, because clearly even US is a domestic consumption driven economy, and you have seen what they have done in their best years when it was transforming itself from a developing world to a developed world. So clearly India, you have a good Hindu rate of growth which will require certain amount of consumption. Then you have inflation which will require further increase in the expenses, and then you have the per capita income which are very low as compared to even China or other developing markets, and there is huge population which is offering you those opportunities of improving per capita in consumption, and the desires to buy new products, the desires to own new products, the desires to even basic things like housing, there is a huge demand expectation, because your mortgage to GDP is one of the lowest in the world. So clearly there is lot of opportunity, there is lot of potential in the Indian economy. However, having said that, obviously there are ifs and buts, because you have, let's say, 20% of the population below poverty line, which would take time to come out of that poverty. You have a large section of population which is middle class, which for some reason, because of the taxation issues, because of the inflation issues, it is two steps forward, one step backward. And then you have a large 10-20% of the population, which is a rich community, which drives 60-70% of your GDP. So clearly you have to bifurcate your India story into this basket. And given the metrics what we have seen in the other emerging markets, especially China, if you take an example from that perspective, I think there is huge propensity to grow. Maybe a wild guess would be, can you have 6% average GDP growth, real GDP growth for next 10-20 years? Answer is yes.
Okay. And how do you foresee the next 500 days of the government in terms of, we all know that elections are a very, very big thing in India. So the government has about 500 days left. How do you foresee that playing into the entire capital market story?
So I think I would say coming back to power is very important, because you will have stability in the reform. So that is important. Second, whatever programs they have envisaged and they have implemented, I think that continuity is very, very important. So be it capex stories, be it implementation of infrastructure across the board, I think that is very, very important for this for continuity of the of those projects. So I think the first point is to continue the momentum of capex or capacity creation to create jobs. Second is to rein in inflation, because clearly inflation is going to be an important issue getting into election, and we have seen inflation can bring governments down. So clearly, I think this government understands that very well. And I think the sole objective of Reserve Bank of India to contain inflation is also one part is also because of this. So clearly inflation, reining in inflation below 7% or below 6% on an average basis, continue the momentum of growth, even if it leads to slightly higher fiscal deficit. I think that is okay, so long that money is used for productive purposes, because clearly there is a multiplier effect of 3x 4x when you put money into an infrastructure kind of a projects. So I think these two are critical metrics to ensure that the momentum continues. However, the other factors are, I would say, frankly, out of government's control, which is oil prices. If oil remains at $100, I think we are in for a good time. Below $100, then we are in for a very good time. Above $120-$130 for a longer period of time, then I think there will be some worry for India.
Sure. So now let me get your answers to a few portfolio related questions that some of our investors got. First question talks about cash, Jinesh. So across our funds, we've got materially longer. We've got cash levels that are above long-term averages. So how do you see that playing out? And are you pessimistic on the markets? It doesn't look like it from your commentary so far.
No. So I think, see, there is a lot of volatility, and volatility will offer you good opportunities to participate. So as I said in my opening comment, that we are seeing consolidation phase for some period, till the time we have clarity on what's happening in the US in relation to Fed rates, quantitative reversals, how much money will be sucked out from the system, what happens to Europe, what happens to Ukraine, Russia, what happens to China. So there is a lot of volatility around, and every day you see markets are either up 1% or down 1%. So clearly that offers the opportunity of whatever flows we are getting. I think we are trying to invest judiciously rather than going all out, because again, we should not forget that you are in times where it is going to be a bit difficult to understand which way things will move.
Sure. And of course, you are looking at the next 3 and 5 years, not the next 3 months, correct?
Correct. So see, even if I invest next money into 3 month period, next 3 month period, I will get, I hope, will get good opportunities to participate. And if I'm looking for 3 to 5 year period, then I think near term cash level shouldn't be a matter for us.
Sure, sure. And in terms of the way your portfolio has been structured, are there any recent changes that you have done that that will help you get out of the underperformance rut that you've been over the last 18 months?
No, I think Shane, I think if you go back to history in 2013, 2016, when we had not done well, if you really see the portfolios of those years, I think nothing has changed. I think what changes is how earnings growth come by. And once our portfolio company starts delivering on numbers, and they have already been delivering. So I'm not saying they have not been delivering, but as we pointed out that because there was a relentless sell-off of FIIs, you did not get the fair share of flows despite delivering good numbers. I think as and when both things come in your favor, I think things will be much better.
Sure, sure. One question is on small and mid caps, Jinesh. So while you predominantly run large capish portfolios, we've seen a lot of wealth destruction happening in small and mid cap names. How are you positioned on those, and what's your view on weeding out a lot of these wealth destructing stocks?
See, clearly, mid cap and small cap are a difficult babies, I would say. You have to tread carefully because if you go wrong, then it becomes difficult for exit. So entering that stock is very, very easy. Exiting is a nightmare. So some of the qualitative factors which we look at into mid cap, small cap is first is the business has to be long term in nature, not short term in nature. So we avoid some of the sectors, some of the companies which are here for 1 or 2 years or 3 years kind of thing. Second, there has to be some kind of innovative metrics blended into the business model, because then only that mid cap can outperform the other large cap peer in the same sector and try to become large cap, right? So there has to be some business model innovation which can bring that company to next level. And third, and the most important, I think, and that goes across our portfolio, is the corporate governance. I think a lot of money has been lost in mid cap, small cap because of the corporate governance issues. And that is where you don't want to go wrong as much as possible. It is not that we don't go wrong, but the idea is we have to learn from those mistakes. So clearly, long-term businesses, innovative businesses, innovation in the businesses, and corporate governance are the three critical metrics we look for to eventually look for that company with a view that this is a small cap as of now. Can it become large cap maybe 5-10 years down the line?
Sure, sure. A little bit about our overseas funds as well, Jinesh. So, as our viewers know, that we are a JV between Axis Bank and Schroders, and Schroders has been advising us on several of our strategies on the international side. So, Jinesh, in your discussion with Schroders and their investment managers, how do they perceive global markets, and how are they building their portfolios today?
I think clearly there is a cause of worry in the global markets, because there is, as I said, there is too much happening. So let me just give you some iteration what we had discussed with them, let's say around 3 to 4 months back. So clearly, you have seen how China has done in last 2 year period, and clearly it was the thought that China is offering a good value, and let us move into China aggressively. And there was a lot of rotation which has happened. Whatever money was there, whatever outflows has happened, but whatever money was around, I think lot money moved out from India or other emerging market and moved into China, feeling that China has not done well for 2 years because they had clamped down on many sectors, and now it is time to participate. After that, China was down by around 5 to 7%. So clearly, the thinking was that China is a good values hub as of now, and once things improve, China will bounce back very nicely. But unfortunately, they didn't come out as expected, and you have seen China's GDP growth was around 0.4%, the latest print which came. So again, that is creating some ruffles in the overseas investors community. That now what happens, even the COVID scare in China and the way they have clamped down, I think it's a very different approach what that country has taken. So it is difficult for them also to really move their money from one zone to another, or one country to another, or from one emerging market to another emerging market. So clearly they are also a bit cautious, nervous, but hopefully again treading on the same line that things will stabilize over next 3 to 6 month period, and you should be and one should be doing well after that.
Sure, sure. And in terms of this is, I think this is a question that's coming back on your philosophy, Jinesh. What are the qualitative metrics that you're looking at currently in terms of analyzing corporate governance issues?
I think it's a very difficult question to answer because it has arts and science both. So there is one metric which we look from the annual report, which is clearly how the board is structured, how the remuneration committees are, how the risk management committees are placed, how many independent directors would have attended the board meetings, what is the auditor's report. Auditor's report become very important. So these are more of a financial metrics which you can find out from the annual report. What is their ESG approach, environment, social governance, whether their companies are coming out with business sustainability report, and whether they are doing good for their society. Society, I mean the vendors, the customers, the ecosystem, and also the employees. So these are more of a quantitative and financial aspects you can find out from the annual report, and while going through their websites and various other reports. However, the subjective aspect is about the management and what is the intent of the management, whether they are here to reward shareholders. I'm sorry, I cannot dwell more into that, but I think that is more important to understand the intent of that management, whether they want to really share their wealth with the minority shareholders, or they want to take everything with themselves. And that is I think a very detailed job which we really go into. I'm not saying we are always right, but the idea is to filter out some of the companies which are poor in those aspects, and concentrate on the companies which are here to reward minority shareholders.
Sure. Coming back, Jinesh, there's one question on, you said India is a very domestically strong economy, but yet your portfolio is very export oriented or external oriented. How would you address that?
No, I think clearly, see, you need to balance out everywhere, right? So you cannot have full 100% into Indian portfolio, because clearly it is a risk one is running. If God forbid, if something goes wrong, whether your portfolio is akin to stabilize the performance by having some of these stocks which are getting money from selling products to the overseas market. So we are more of an, so the idea is to have, let's say, 80-20, 70-30 approach, which balances out the good times of the market, bad times of the domestic market, versus good times and bad times of the export market. So clearly the thought process is it's a bottom up approach. Identify companies which are doing well in India, identify companies which are doing well on the export side, making money for the exchequer, and try to balance it out.
And I believe as a shareholder, you don't mind where the revenue comes from, as long as it's high quality, profitable revenue, right?
Correct. But we have to understand, if you want to play India, then India is a domestic consumption driven economy. So large part of the portfolio has to be around that. And then to hedge it out from a portfolio construction perspective, you can get into exports.
Sure. What is your view on crude prices, Jinesh? Do you, because you gave us a scenario analysis, but what is your realistic view of crude, and where does it end up for the year?
See, frankly, very difficult to give you a view because it's a global subject. There are so many forces at play. There are so many geopolitics at play. So, and sitting out of Bombay, I think it is difficult to give you a very concrete view on oil or any commodity or even gold. What I can say is, if you take scenario analysis and how we operate in the portfolio is, uh, the best case is oil below $100. India's inflation is under control, currency is under control, is stable, and you have momentum of growth coming back. Because if your oil is down, clearly your end products prices will be down, your raw material prices will be down, margin pressures will be less for the company, and companies will start showing good numbers. If oil is between $100 to $120, clearly we can manage it. We are managing it now for last 2-3 months. We can manage it, but there will be some shave off in terms of GDP growth. From 7 we will go down to 6.5,
Yep.
or maybe from 6.5 will go down to 6, something like that.
Yep.
Oil above $130 for a longer period of time at this currency levels, I think it is going to be tough for India. So then the shave off can be bigger. So, and I don't want to get into numbers, but then the shave off can be bigger because the pressure on fiscal deficit, pressure on current account deficit will lead to pressure on the interest rate scenarios, pressure on the currencies, which generally might not go well with the FII investors. So I think oil at 100, I think I would say is the best case to work around and build up our portfolio. Then the risk remains is if oil just goes to $130 and stays there for a longer period of time.
Okay, fair enough. And one investor, Suraj from Vadodara, asks, India's investment cycle is showing nascent signs of revival. What sectors do you think would best reflect that capex recovery?
So I think anything proxy to infrastructure, anything proxy to manufacturing should do well, whether it is capital good stories or whether it is product stories or whether it is building material stories or so on and so forth. So I think, see, in a nutshell, anything proxy to infrastructure should do well.
Okay, great. And what do you think about SIP flows? I believe SIP flows have come off this month. What do you forecast with the domestic bid waning off? Is that a concern?
See, it is always a concern, right? We had, if you see, after demonetization, the way flow started, and again it tapered off, and now again after this COVID, we are seeing these huge flows coming. See, I think clearly you would see some tapering off because clearly money is now being used for other purposes also. FD rates are going up. See, large part of, I would say, and this is just an indication that let's say 10 to 15% of money which would have come in last 2-year period might be because of lower FD rates, right? And once the FD rate starts moving up to let's say 7.5, 8%, some of the NBFCs have started giving it. I think it will be logical for some people to take out money or stop money investing into the market and go back there, because there is always a risk of other things. There is a risk of inflation, so you need to diversify that way. So I am not worried that way. Flows will slow down. Obviously, it is a cycle. It always has a good times and not so good times. So I think so long we have a strong SIP flows, the lump sum flows, even if it abates, I think it is okay. I think SIP flow is more structured long-term flows, which people would not disturb unless there is a huge inflation scare.
Okay. And you spoke about asset allocation. I think it was very critical, at least in the last 18 months or so. How do you foresee an ideal asset mix if someone was to ask you today?
I think it depends on the age of that investor. So clearly, I always say an investor above 60 years of age should have, let's say, 30-40% equity and more of debt. Investor, I think between 30 to 50 years of age obviously can take higher risk, 60-70% of equity and balance debt or something else. An investor below, let's say, 25 years of age can take 100% investment, long-term investment bet in the equity markets. Clearly, because the power of compounding, if you really see any good funds over last 15-20 year period, they would have delivered a good compounding returns. So if you take that as a historical metrics, then I think depending on the age of profile of the investor, I think one should bifurcate into asset allocation.
Sure. Well said, Jinesh. Finally, I think I'll try and close these off. What is your perception of where smart money seems to be moving? Jinesh, smart money.
No, I think smart money unfortunately moves very fast also. So so it moves to Bitcoin, cryptocurrency. Again, it comes back. Again, it moves. So I think what I'm sensing is the smart money is coming to equity. Obviously, it will be slow and steady because, as I said, we are in for a consolidation phase. We have seen a good 2 year period. Normally, if you see the cycle, you will have lull of 1 or 2 years. You will have good 1 year, and again that lull. So I think smart money will start moving into equity once the stability comes, and that is where I think you should put your bet.
Sure. And one final question, Jinesh. What are the sunrise sectors that you're seeing? Every bear market throws out a new sunrise sector. So what are the sunrise sectors that you are seeing at the market currently?
See, leaving aside the valuations, because some of the sunrise sectors are loss-making companies, and I would say they would have not listed at a right valuation to some extent because of the froth in the system which was there. Now most of those companies are coming back to their senses. Companies are now talking path to profitability. So I think internet-based companies, I think I would say it's a sunrise sector if played very well.
Okay. So you are quite optimistic on the internet names. Is that right?
Shane, what will happen? I will tell you. Out of 10, one will do well.
Okay.
Because that is the nature of that startup or the sunrise sector, right?
Yeah.
So once in a particular segment, once things get clear, once that company has sizable market share in that segment, I think then they will start doing very well. However, as I said, valuation are still frothy given the metrics what they are using. So once things stabilize, I think you will see again renewed activity in those companies.
Sure. So I think Jinesh, thank you for answering a whole host of questions from our viewers. And viewers, thank you for joining in. We do hope to get Jinesh sometime soon again to answer all your queries. I'm sorry I was not able to take all of those queries, but rest assured, I think we are in good stead over the next 6 months. Once again, thank you for joining and happy investing.
Thank you, Shane. Thank you for organizing.
Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.